Welcome back to our Citi Market Watch series, the second episode. Hope you're all hunkering down safe at home. One thing to note is that we are very lucky to have the technology we have now to survive this pandemic. The goal of this series is to give you meaningful updates in the market and how this impacts your investment strategies and portfolios. Recently, we have seen volatility and weaknesses as the markets have tried to digest the unexpected disappointment in US payrolls and extraordinarily strong US inflation numbers. US employment was expected to see further gains of around 1 million new jobs, but instead only grew a mild 266,000 in April. The unemployment rate rose to 6.1%, and adding further concern, previous months' gains were also revised downwards. Whilst US inflation expectations have risen, the April Consumer Price Index rose a huge 4.2%, much higher than expected. This current pace of inflation is the fastest since 2008 and the largest since 1981. What does this mean? Are we headed for stagflation? Is there value in holding bonds in a portfolio? Is this tech or growth correction the start of something bigger that could have greater consequences for investors' portfolios? These are all worrying yet interesting considerations. Audrey, how should we think about these developments?
Well, it is worth noting that these are very much US issues and problems, and we are not seeing significant inflation risks in Europe and across Asia and emerging markets. Inflation continues to be well within its normal ranges. And when we think about the US, well, this is like opening a box of cockroaches, everyone's worst nightmare.
Stop, I cannot get that image out of my mind.
Well, it is potentially a horror scenario. Rising inflation combined with rising unemployment is a toxic combination. But you must remember a few things. Now, firstly, we are expecting significant base effects from March last year, when inflation was literally non-existent. And so, as activity has resumed in the US and the rest of the world, we are seeing these very impressive or alarming year-on-year comparative statistics. Now, breaking down the inflation components, Citi Analysts continue to stress that the surprise was very much due to transitory factors like used cars, lodgings, rental, hotels, and airfares. Secondly, although US payrolls disappointed, it was still a positive number and an improvement compared to previous data. Now, the US is still adding to employment, and the likelihood is we will see payrolls bounce back, given that most other data sets and surveys continue to show US labor market strength. For example, US wages or wage growth has remained steady throughout the pandemic, but saw a significant rise in April, a reflection of how tight the market is.
So whilst the jury is still out, US inflation risks remain in the transitory camp. But what it does mean, Audrey, and the markets are happy about this, is that the Fed will remain firm on its outlook to keep overnight rates anchored. Expectations for a change in the Fed's stance to think about tightening remain set towards the end of 2022. But this does mean that the US yield curve is going to stay steep, if not steepen further. What does this mean for bond investors or investors in general, especially those who have exposure to the US market?
Well, bond investors, especially those with higher allocations to the US, should be reducing their duration risk, meaning you don't want to have long maturities. Now, the reflationary or improving economic environment will support credit, meaning that default risk will likely remain low. And so high yield with short maturities favors this outlook. Now, remember the Fed is anchoring the overnight rate, keeping it low, but the improving economy is pulling inflation expectations and yields higher further out the yield curve. The economy is improving, and so ultimately, when the Fed lifts off from zero, there'll be a broad move higher in yields. And you want a manager that has this flexibility in their duration and has skills in owning credit.
Thanks, Audrey. That makes a lot of sense. And it is probably worth noting that outside of the US, for so many of our clients and investors based here in Singapore and Asia, that opportunity remains unchanged, meaning Asia and emerging markets have always had higher yields and on average, lower duration across investment grade and high yield. This gap remains large at almost 3%. One way to think about this is if you look at all the bonds in the world, only 11% of those bonds have a yield greater than 3%. No surprise given that over a quarter or around 17 trillion worth of bonds have a negative yield. You can now really appreciate the value you get from strong nominal and real yields across Asia and emerging markets. Emerging market sovereign debt yields, for example, deliver a comfortable 5%.
So be mindful of duration and credit, but also look for more attractive opportunities across Asia and emerging market fixed income.
It is also worth noting that as global yields have fallen, dividend and earnings yields have outpaced bonds across asset classes and within. We see, for example, the Eurostock index with a dividend yield of 3.5%, whilst the German 10-year bonds are negative and US 10-year treasuries are at 1.5%. That's a big yield gap. For corporates, broadly 60 to 80% are paying higher dividend yield over their bond yield. With expectations for strong earnings through 2021 and into next year, and a rebound in GDP growth, one can understand why so many, as well as Citi analysts, see the value in being overweight equities post-March, last year and going forward. Having said that, Audrey, what are the risks going forward for equities?
Well, thanks, Sun. In short, it is a fine balance between the optimism around growth and reflation versus the perceived inflation risk. Now, over the short term, we are likely to continue to see the market discount growth as inflation risks rise. But as we highlighted in our Citi Market Conversations webinar last week, history has shown that equities do very well in rising rate environments, as it is ultimately a reflection of accelerating economic growth and corporate earnings. Now, remember too that the pandemic has accelerated and brought earnings forward, especially in online e-commerce. So for example, just think how glued we all are to Zoom, e-gaming, or any other streaming media. Now, this growth will continue, but the pace will moderate, as we have seen in Q1 results over recent weeks. And we all need to be conscious of this.
Thanks, Audrey. So we should appreciate equities for what they are, but keep our feet on the ground. In our previous episode, we talked about President Biden's infrastructure plan. And it is worth noting that even without all these initiatives, infrastructure is genuinely a nice down-to-earth allocation. It is a bond proxy or a defensive equity income yielding asset class that's very much in favor. Just think about every time you drive through that CTE gantry. Infrastructure assets range from everything from toll roads, cell phone towers, data centers, to the usual waste management and utilities. Individually and together, the yields and total return expectations are healthy, outpacing on average almost all fixed income strategies.
Well, to sum it up, Sun, markets are messy now with volatile data points, but it's important for investors to note that reflation continues, and whilst we are risk on, we should moderate expectations and allocate to ensure that investment strategies and portfolios are more balanced.
Thanks, Audrey. And thank you all for tuning in for another episode of Citi Market Watch. Please talk to your Citigold or Citigold Private Client Relationship Manager for more opportunities.